Thank you to our colleagues from Exprim for inviting me. I'm very happy to be here, not only because it's always nice to see colleagues, but also from conceptual perspective. Basically, this event is aimed mostly at the industry and various providers to the industry. However, I believe in such a highly regulated industry as ours is, I think it's very important to have a reasonable, I call it supervisory dialogue. For me, it's very important to be here because if we want to properly regulate and supervise the industry for the aim of the benefit of the consumers, we need to understand the business. And it's only on such events that we can really go in depth to understand what the industry is doing. On the other hand, I also believe in transparency of the supervisors. We are not liked as the regulators because basically we are posing limits to your business on one hand. But on the other hand, I believe if we can publicly disclose what are our supervisory expectations, it will be much easier for you to reach such expectations. So thank you again for the invitation for these reasons. Secondly, why I slightly changed the title of my presentation. Alexandru kindly asked me if I can talk about profitability, about what is going on in motor insurance in relation to Solvency II. I think we have talked on Solvency II per se for years and years and years now. I was actually thinking from one of the strategic aims or objectives of European Insurance and Occupational Pensions Authority, EIOPA, which is consumer protection. Because now when we basically implemented Solvency II, the next big project is consumer protection. And EIOPA, well, I'm going one step back. 2 years ago, I was listening to Mr. Paul Sharma, who was head of the policy at the UK FSA at the time. Now he's with the consultants. He went to the dark side, and but basically he's one of the fathers of Solvency II regime. And I asked him at the conference 2 years ago, what do you believe will be the most important factors changing the business model of the industry? And basically he said there will be three issues. One will be the digital technologies, on which we are going to talk today afterwards. The second one will be prudential rules, which are basically contained in Solvency II, and we are more or less familiar with them now, although we still don't know what will be the actual impact. And the third factor is the rules which will affect business conduct or consumer protection. And I do believe that the changes in the consumer protection rules will fundamentally change the business model of the insurers. And EIOPA has last year, in 2016, issued the product oversight and governance guidelines for the insurers and for the intermediaries. And these guidelines at first glance seem just to state the obvious, but on the other hand, if we go in depth, I do believe they are really a game changer. First of all, these guidelines basically present the key consumer protection tool in the following sense. Before, we have had the prudential rules, which also included the rules on the governance, and basically it was relating to the risks of the company per se. On the other hand, we have had consumer protection rules, which were basically rules about disclosures, rules about what should be contained in the insurance agreement, etc. And there was no really direct link between those two. Because Solvency II started as a comprehensive approach towards the risks, basically it was recognized that market conduct or consumer protection risks are really fundamental for the insurers. And the product oversight and governance guidelines basically close this gap between the two of them. This sounds very, very theoretic. Practically, if we have a case of mis-selling or of a bad product towards the consumers, the top management of the insurance company will be held ultimately responsible for it. And this is basically this connection between prudential and consumer protection rules. Secondly, the guidelines have been issued, of course, in the form of guidelines, which means that per se they are not legally binding. However, at least in my jurisdiction in Slovenia, we found that we have enough legal basis in the Solvency II basically to implement the guidelines. The next important issue is that basically these guidelines are preparatory phase for the IDD adoption. And one important issue is that they are applicable to insurers and to distributors. However, you should note that the guidelines don't speak about insurers, but about manufacturers, which for me, it really sounds strange that an insurer is a manufacturer, but it's a question of language. As I don't want to spend too much time, I will go very quickly through the guidelines, and then I will probably try to focus more on what I see as the applications of the guidelines on the motor industry, on the motor part. So basically, there are three main objectives of product oversight and governance guidelines. First, of course, is a very general objective to prevent and to mitigate customer detriment. Of course, every regulation is aimed at the value for the customer. Secondly, it's about support for a proper management of conflicts of interest. Basically, this arises of this anomaly in the business model or in the sales model in insurance, whereby all the main remuneration, let's say, expectation is in the form of commission. Now, it's a big debate at EIOPA level whether the European should ban, some form or not commissions, but I think this is for another opportunity. The third one is, which is really important, that the insurer or the distributor should really ensure that the objectives, interests, and characteristics of the customer are duly taken into account whilst designing or whatever doing with the product. So basically, it's not about designing a product, which we believe it makes sense, and then put it on the market and let's see if it sells or not. But in the phase of design of the product, it should be the designer of the product should keep in mind for whom this product is really beneficial. The key features of these guidelines are basically that when they are talking about the product, they are talking about the whole life cycle of the product. We have had in my jurisdiction long debates what actually an insurance product is. Is insurance products only terms and conditions and the price at these terms and conditions, or is it something more? Basically, the approach from the POG guidelines is that a product means everything from the start of the design phase until the provision of after-sales services. So everything which is connected with the product is considered to be part of the product. When we are talking about what should the insurers do about their products, it's not about, it does not mean that the EIOPA wanted to introduce via backdoor some kind of product approval or something like that. It's about the processes. We are talking about risk-based approach as within the Solvency II system, and the risk-based approach, the first assumption is that the supervisor or the regulator cannot be more clever or cannot know risks better than the insurer itself. So it's about the processes the insurer will establish and implement in respect of the adoption of, in the process of adoption and implementation of the new products. And it's about internal controls. Thirdly, which is very important, the POG guidelines are applicable to all products, which complicates the things because there are hundreds and hundreds of products on the market, and some are simple and some are not simple. And I have a special slide which is very important at the end, and it's about the application of the principle of proportionality, which is important because otherwise it just doesn't make sense. We don't want to kill industry with overregulation. The fourth point, which for me, at least from my practical experience, is the most important, is that administrative, management, and supervisory body of the insurance company, bodies, should hold ultimate responsibility for anything which is sold on the market, from the design phase to the after-sales process. In my jurisdiction, we have had a problem. We are a similar market like we are a typical Central and Eastern European market, similar both to what is south of us, Croatia, etc., and what is North Austria, and so on. We have very strong agents networks, outside agent networks. And the case was, because it was an outside agents network, basically the management said, we are not responsible for it, just penalize the networks, which systemically didn't make sense. We want basically the top management of the insurance company to be responsible for everything. If they are working with outside agencies, they need to establish proper controls to control the business which is sold via such channel. And the fifth important point from practical application is that basically it's aimed at the bad products and bad sales practices. Again, I'm speaking from my experience. On our market, we don't have bad products per se. Bad product would be a product which would offer not enough coverage, in a sense, for price. All products are reasonable. However, we have huge problems in mis-selling. Basically, the neutral products are sold to the populations which don't need or cannot afford them. On the other hand, a bad product, an example of a bad product would be the famous case from the UK, the payment protection insurance, whereby the banks were selling something to their clients which didn't afford them any cover. So as I said, POG is applicable for the insurers and for the distributors. In respect of the insurers, it's basically what I already said, that they need to establish proper procedures in adopting new products. They should review such arrangements, and the arrangements, as everything else in Solvency II regime, should be well documented. Again, the most important thing is that the management is responsible for everything in connection with the POG arrangements, including its implementation. I'm going very quickly through this because I want to spend more time on the motor issues, but Alexander will make the slides available. Another important thing which is important, and we have had a long debate on IIS, which is International Association of Insurance Supervisors, and on the EIOPA level, is about target market in the context of motor. Basically, when you design a product, you should identify your target market, take into account the needs of the market, the financial literacy, i.e. the understanding of the market, and the financial capability. The motor insurance holds a special place in this sense, because motor insurance on one hand is very standardized, but on the other hand presents disproportionately big expenses for normal consumers. And the risks associated with the use of motor vehicles are disproportionately large as compared to other risks by normal consumers. So how to identify the target market? For example, if you are trying to offer higher sums insured in the MTPL, how to identify target market if you are offering comprehensive insurance products in motor hull or casco? How do you identify the target market? Especially the big problem in motor insurance is in bundled products, where on one policy you have, let's say, MTPL, motor hull, and personal accident. That's my case. Or maybe you can even add motor assistance. How can you identify really target market for a complex product? So this is an issue tied to motor insurance. Then every product should be tested. Now going to the distributors, basically the distributor should take into account what are the needs of the clients, of course, and it should really focus on its processes in relation to the information which the distributor needs from the insurer in order to properly place the products on the market. This is again about the obligation to obtain proper information. Distribution strategy. In our experience, for example, the insurers would make a distribution strategy which would fit with insurers' overall strategy, but the distributor would have a different business model and would make a completely different distribution strategy. Basically, those two strategies should be aligned, having in mind, of course, primarily the interests of the policyholders or the consumers. Now I am coming to what I believe is the most important part of my presentation, the last two slides. First of all, sorry. Why it doesn't work? Again? Now I want to have a slide. Everything else was just introduction, more or less. No? or you can move it to the, maybe Adriana can move it on the computer. No? Can you move it on the computer, maybe? Okay. I mean, in any case, we got so used to the presentations, but 20 years ago, everybody was speaking without a presentation, so. Ah, okay. No, but one back. Yeah, this one, yes. Okay, proportionality principle. So, as I said, POG guidelines now, and in the future with the adoption of IDD directive, it will not be only guidelines, it will be legally binding for everybody. Every insurer needs to follow the POG guidelines for each and every product it is designing. As I already mentioned, as you have hundreds and hundreds of products, we need to make basically some sensible discrimination between them, and it's about the applicability of proportionality principle. Now the main issue always is how the proportionality should be applied. Usually, I mean, at least the simplest application is if you say there is a smaller entity which is regulated, basically you put less onerous requirement of them. But it doesn't make sense because it should be applied in relation to the risk to the consumer. So basically, proportionality should be applied. The arrangement, the POG arrangements should be proportional to the level of complexity arising out of the product itself, but only secondly, to the nature, scale, and complexity to the regulated entity. So if we have a complicated product which is expensive for the client and presents big coverage for important exposure and a lot big monetary burden for the client, even if it's produced by a small entity, the proportionality should not be applied. There are some factors which should be taken into consideration in applying proportionality. First of all, the motor products are well established. People know motor products, so in this sense, proportionality works well for your part of the business. On the other hand, the important thing is that motor products affect vast parts of the population. Almost everybody has a car and needs to insure something in connection with the car. So basically, it should be assumed that an average consumer of motor products is not well financially educated. Thirdly, motor vehicles present a disproportionately large exposure for many customers. First of all, the car itself has a big value. Secondly, of course, via the MTPL insurance, the exposure is huge, and basically, in this sense, the market should be properly informed of what they are buying. Can we move forward? Because I have 1.5 minutes more. And now I'm just going to some specific issues relating to motor insurance. First of all, in the design phase, we have identified together with the colleagues at EIOPA how will you, as the industry, implement POC guidelines taking into consideration segmentation? Michael talked about what are acceptable factors, what are not acceptable, what are fair factors, and what are not fair. I don't have an answer, but I think the industry should keep in mind, whilst pricing, what would be beneficial for the consumer and fair for the consumers. Second issue which we identify is about bundling. Again, if you have on one policy motor hull, MTPL, personal accident, and motor assistance, you should give always an option to the consumer to opt out of the coverages which are not appropriate or not needed by the consumer, which at least in my experience sometimes is a bit hard. Secondly, on the sale process, explication of coverage. Basically, the sales team should be able to explain the coverage. Of course, it seems very easy if we are talking about MTPL, but it's not only about MTPL. First of all, on motor hull, we have complex coverages. Secondly, there needs to be a consideration if, for example, a car is older than 4 or 5 years, whether to insure it for total loss only or also to partial losses. Does it make sense? Is it beneficial? And here is a big issue in product oversight and governance process. So it is applicable in motor business. Thirdly, it's about deductibles. What is an appropriate deductible considering the financial status of the consumer? Fourthly, you have mandatory versus voluntary coverage. In my experience, from my jurisdiction, basically, I come to the agent. I say I need my mandatory insurance, and the agent automatically sells me with the double sum insured without explaining to me that I'm buying something which is not mandatory. Which is not to say that this is bad, but basically it should be explained, and whether it's important for me or it's not important for me. Or for example, when it's in Slovenia also a bad practice that you buy driver's personal accident insurance in the same package with MTPL and nobody knows it. Buying coverage the customer is not aware of. In Australia, you have motor products when you buy MTPL with the car repair shops, with the loss ratios of between 1 and 3% because people don't know that they bought it. It's a wonderful product, but from this perspective, it should be explained to the clients. And of course, everything which is connected with the claims services, i.e. basically the consumer should have the opportunity to get the money or to repair somewhere. I have finished on time. Thank you very much.